Here we go. Good morning, everyone. My name is John D'Antona, and I'm the Director of Marketing here at CAPIS. Welcome to our first research briefing of 2023. CAPIS would like to thank all of you for taking the time out of your busy day to spend with us. We hope that you find the following information in today's briefing useful. Also know that CAPIS records and saves these editions on our YouTube channel for future viewing. So in case you missed something or would like to review a portion of or all of this broadcast, please visit the CAPIS YouTube channel and select Research Briefings. You can also read a brief recap of today's event on our website, www.capis.com. It's the new website. Click on our Insights tab and select Monthly Research Briefing. But before we get started with everything, I got to read the legalese. The opinions expressed by the featured speakers do not necessarily reflect the views of Capital Institutional Services, CAPIS, or any CAPIS ownership, or any CAPIS management not providing said opinions. Any comments and or information presented within this presentation are for the sole use of institutional investors. Nothing in this presentation should be construed as an offer, invitation, or recommendation to sell, or solicitation of an offer to buy any securities that might be mentioned. And now, of course, I'd like to turn it over to JC Parets, but before I do, please note that JC will take questions at the conclusion of his remarks. Simply type them into the Q&A portion of your Zoom, and we will be sure to get back to them. And now, on with the call. We'd like to welcome JC Parets, CMT. He's the founder of AllStarCharts.com, a technical analysis publication for hedge funds, mutual funds, financial advisors, family offices, and other investors. He's got almost 20 years of experience on Wall Street with a focus on equity research, money management, and technical analysis. In 2012, he founded Eagle Bay Capital, intending to manage money through one portfolio in a limited partnership. He also has launched the AllStarCharts research platform, All-Star Options, and AllStarCharts EDU. Since the start of AllStarCharts, JC has been featured regularly on Bloomberg, ABC, Wall Street Journal, CNBC, Fox Business News, Yahoo Finance, and a slew of other media outlets, and we're proud to have him with us. JC, welcome.
Listen, thanks for having me. Always happy to do it, John. Do you want me to share my screen? How do you want to do this?
Yeah, you can share your screen. Go right ahead. I'll turn it over to you.
And then feel free to go ahead and interrupt me at any point with any questions that you might have. You're able to see the screen. You can hear me all right? We're all set?
Yep, we're all set, JC. Go right ahead.
All right, rock and roll. Listen, I appreciate the introduction, guys. You know, what I'm going to try to do here today is just share what I'm seeing in the market. You know, just a little bit of background. I really don't care. I'm asset class agnostic. I'm direction agnostic. I don't care if the S&P 500 doubles or gets cut in half. Gold can go to 10,000 or zero. Doesn't matter to me. You know, I'm just trying to make money in the direction of underlying trends. I just want to be on the right side. So no biases here. I really couldn't care less what the market or the economy do. That's not my problem. My only concern is my portfolio. And I am incredibly fortunate to have investors all over the globe of all different sizes of AUMs, from the biggest hedge fund managers on the planet to the biggest banks in the world, to individual investors first opening up their first Robinhood account, and everyone in between. A lot of financial advisors and traders and things of that nature. So I get a really broad perspective on what's going on in the market, different asset classes, multiple time horizons, and everything that we do here is on multiple time horizons. We start with a longer term view, you know, bigger picture, really put things in perspective, and then we drill down. I might be for example, I'm day trading Google as we speak. I have an irresponsibly long position in Google that I might be taking profits on in the middle of this presentation. Maybe I'll get stopped out of it in the middle of this presentation. I also have longer term positions as well in different portfolios. So I've got a lot of things going on from an execution standpoint. But forget all that and forget what I'm doing. From an analysis standpoint, we use the multiple time frame approach, starting with a longer term view and then drilling our way down to more tactical opportunities. My Google day trade is a little bit extreme in terms of the short term. Really where I live is looking at weeks and months, trying to make money this quarter. That's really our sweet spot. We just happen to have a really killer day trader on our team, and I'm getting going on my day trading, something I've always wanted to do. And now I have more time on my hands at work for a variety of reasons, and I'm able to dedicate a little bit of time to the day trading. So that's what that's all about. All right, so obviously nothing we talk about should be construed as any sort of solicitation. These are not buy or sell recommendations. This is strictly for informational purposes alone. Make sure to go to allstarcharts.com/terms. Check it all out there. We pay our attorneys a fortune to write this stuff, so somebody might as well read it. And what I find it, really interesting is, people are like, oh, JC, when is the bear market going to end? This is such a tough market. Stocks, they keep going down, the recession and, the Federal Reserve and the Powell and the Trump and the da-da-da. And it's just like everyone's always complaining about things. Meanwhile, we came into this week with the Dow Jones Industrial Average less than 6% from new all-time highs. This doesn't look like a bear market to me, really, of any kind. And, contrary to popular belief, I don't think that we're in a bear market. Quite the opposite. I have a lot of data that suggests that the bull market started 7 months ago. The list of new 52-week lows peaked in the second quarter, right? You can argue we are now month number 8 of this bull market. And sure, some of the large cap American growth heavy indexes made brief lows in the fourth quarter for, maybe for like a hot second. But by that point, there were basically no stocks left making new lows. So let's talk about what a bull market is and what a bear market is. This 20%, the S&P is up 20%. If you think that the S&P 500 up 19.9% is not a bull market and the S&P 500 up 20.1% is a bull market, you should see a therapist. Right? That's how serial killers think, right? This 20% stuff is nonsense, right? So anybody who thinks that that's what categorizes a bull market, you should run as fast as possible away from that person. The bottom line is this. In bull markets, what happens in bull markets? Stocks go up, right? You have more and more stocks going up. You have more and more stocks making new highs. You have more sectors participating to the upside. You have more sectors making new highs. You have more countries around the world making new highs, going up, right? You have fewer stocks making new lows, fewer sectors and countries making new lows. The parties are more frequent and better with more people and better food and drinks, right? Those are the types of things that happen in bull markets. Whether you're a super bearish or super bullish, I think we can all agree on that. That's what bull markets are. What happens in bear markets? Well, stocks go down a lot, right? Quite regularly in bear markets. You have more stocks making new lows, more stocks going down, more sectors and countries around the world going down and making new lows. You have very few stocks going up. You have very few stocks, fewer and fewer stocks making new highs, fewer and fewer sectors and countries making new highs. Those are bear markets, right? The parties are less frequent. The parties are attended by less people. It's a cash bar, not an open bar, right? These are the types of things that happen in bear markets. So, all right, what's been happening now? Stocks are going up. There are just no stocks left that are going down. More and more countries are going up. More and more sectors are participating to the upside. This is coming into the week. This is all of the S&P sectors on an equally weighted basis. Consumer discretionary is up 24% since June. People are like, oh, the end of the consumer. Oh, consumers can't afford anything. It's like, I guess, but consumer discretionaries are the best performing stocks since June, up 24%. I'm no economist, so it seems to me like consumers are doing pretty well. Not to mention industrials up almost 23%, healthcare, financials, energy, even technology on an equally weighted basis up 13%. So these are just not the things that we see in bear markets. These are the types of things that we see in bull markets. And from a seasonality standpoint, it makes perfect sense. This is the bullish time of the year. This is a bullish part of the 4-year cycle. In fact, the most bullish part of a 4-year cycle. We've never seen a recession begin during a pre-election year. And, you know, doing some math, this is a pre-election year. And, you know, the time to buy during the 4-year cycle is going into the fourth quarter of the midterm year. And sure enough, the fourth quarter was a great quarter. People were like, oh, bear market, you know, what a hard year. Everybody's losing money. The fourth quarter was great. The fourth quarter was an excellent quarter for equities. It's almost impossible to not be making money in this environment. So if you have found yourself in this environment not making money, I would really reevaluate your approach, because it doesn't get easier than this, right? So if you're not able to make money in one of the easier environments to make money, maybe you should look at your approach and see what's going on, because it couldn't be easier to profit in this environment. Almost everything is going up. Very few things are going down. More and more things are going up. Fewer and fewer things are going down. And like I said, so this is the 4-year presidential cycle. As you can see in blue, this is the cycle. In red is the actual S&P 500 and what it's doing. And it's really moved tick for tick with the seasonal cycles. And as you can see in pre-election years, goes from the lower left to the upper right. Here's the cycle composite that we create for 2023. We take every year since 1950, all of the seasonal trends for the last 72 years. Is that right? Yep, 72 years. Then we take every pre-election year, and then we take every third year of every decade for that decennial cycle, and we equally weight it to come up with our composite. And this is what this looks like. It goes from the lower left to the upper right. So you have seasonality at our wins. Meanwhile, everybody thinks we're in a recession. Everybody thinks that we're in a bear market. The greatest trick the market ever pulled was convincing investors that we were in a bear market, which is hilarious because the data suggests the exact opposite. Stocks are going from the lower left to the upper right. They have been for 7 months. So if you think that this is a bear market, you're either looking at your charts upside down, or perhaps you're looking at your charts blindfolded. I don't know. But everybody is very pessimistic. Consumer sentiment down near record lows. When you look at individual investors, you've got the most consecutive weeks of more bears than bulls that we have on record. So people incredibly pessimistic at the retail level. And then when you go to institutions, which actually move markets, right? Retail investors don't really matter to asset prices. It's the institutions that are moving markets around. And look at the Bank of America fund manager survey that just came out. I mean, we have the lowest exposure to U.S. equities that we've seen in a long, long time. So retail investors are pessimistic. That's definitely a good thing. Institutional investors are pessimistic. That's an even better thing, in my opinion. And what's the catalyst? Why are stocks doing so well? You know, right? People are like, oh, recession and the economy and the Fed and the Trump and the this and that, the war. The dollar's getting smoked, guys. And what do we know about the U.S. dollar? We know that it has been the only safe haven in town for quite some time now. Let's call it 6-7 years. The only one. Last year, stocks got hit. Bonds historically serving as a safe haven. Bonds got hit harder. Treasury bonds got hit harder than stocks. So Treasury bonds certainly not a safe haven. Japanese yen as well, traditionally safe haven. Again, last year making new 20-year lows. Gold useless as always. The only safe haven was the United States dollar. We've seen a very, very strong negative correlation between the US dollar and equities and other risk assets for that matter. And then a funny thing happened at the beginning of October. You know, you had these magazine covers, Bloomberg Business Week, can't stop, won't stop in the US dollar. Then you had the Barron's cover with George Washington jumping out of a US dollar wearing a tank top, all roided up. I mean, if that's not a contrary indicator, I don't know what is. And then sure enough, the dollar has gone straight down ever since the journalists decided that the dollar was in an uptrend. And then let's go back for a second and see, you know, what happened at the end of 2016, early 2017 when the dollar peaked. What happened? Dollar got smoked. How did stocks do? Stocks had one of the greatest years ever. Cryptocurrencies had one of the greatest years ever in 2017, right? And then what happened? I think it was like the least volatile year ever also, right? And then what happened in early 2018? The dollar stopped going down. What happened to stocks? Stocks stopped going up. Crypto got smoked, right? And then the dollar was appreciating for a few years. And after COVID, dollar peaked. What happened when the dollar peaked after COVID and got smoked? What happened to stocks? Stocks had their greatest 52-week period in history, ever, right? And then a funny thing happened in the spring of 2021. The dollar stopped going down. And when the dollar stopped going down, what happened as the dollar ripped? Stocks stopped going up. In fact, you can see here when the dollar bottomed and started to rally, that was the peak in stocks. That's when the new 52-week highs list peaked, and it was just deterioration ever since. So throughout 2021, even though some of the large cap indexes kept going and making new highs through to the fourth quarter of 21, by the time the indexes peaked, most stocks had already peaked well before that. So it's very similar to this, where people are obsessed with the S&P 500, but the majority of stocks bottomed out in Q2. So let's take a quick look at the S&P 500 and see what everybody's so angry about. We could see here the S&P 500 just stuck below this overhead supply here, right? Kind of like stuck in this downtrend channel you can draw here, right? That's what's going on in the S&P 500, kind of a mess, right? And then you can see here just yesterday, new 52-week lows in the S&P 500 relative to developed countries outside North America. Fun fact, international outperformed the United States last year. We have not seen international outperforming the United States on a consistent basis in 15 years. You know, I remember in the 2000s, international was the place to be. The US was the last place you wanted to be. Sure enough, we're seeing the exact same thing. To quote the great philosopher Yogi Berra, it's deja vu all over again, right? So as well as stocks have done, right, which they've been doing great. I don't know why people say stocks are going down. I have no idea what they're looking at. Stocks have been doing great. Had a heck of a fourth quarter, heck of a start to the year too. And even still, they're underperforming EFA. So this is EFA. So there's developed markets outside North America. Think a lot of Europe, a lot of Japan, right? That's what's going on here. You've got an expansion in the new highs list on the New York Stock Exchange. In bear markets, you don't get an expansion of new highs. You get an expansion of new lows, right? So we're getting that. You're getting an expansion of stocks above their 200-day moving average, right? Why the 200-day? Why not the 204-day? Why not the 196-day, right? There's no rhyme or reason for 200, but we can all agree that if a stock's above its 200-day moving average, it's probably not in a downtrend, right? If a stock is below its 200-day moving average, it's probably not in an uptrend, right? So that's what we're looking at there, guys. I want to talk about consumer discretionary because consumer discretionary, we mentioned before, on an equally weighted basis, best performer since June, but on a cap weighted basis, really struggling, really one of the worst performers. I mean, between discretionaries and communications until the last couple of weeks had been the worst performers. But let's remember that Amazon represents 22.5% of that. Tesla represents 14.5% of that. But when you look at the equally weighted, right? So in the candlesticks are the cap weighted. And then when you add the equally weighted version in black here, you're seeing the equally weighted version making 8-month highs. So when you broaden out and look at consumer discretionary, they're actually acting very well. This is about a week old, the chart. So you can see here the equally weighted consumer discretionary really leading the way, cap weighted really flat to down, and Amazon and Tesla have been getting smoked, really, really dragging that down. You know, people are like, oh, JC, you know, the market's going to crash. It's like, bro, the market already crashed. What are you talking about? Some of these tech stocks are down 80%. You're like, and crypto's the scam, right? PayPal's down 80%, right? Crypto's not the scam. It's the humans that are screwing everything up. The average small cap stock was down 44%, smoked. And people were expecting a crash now. I'm not really sure what they're looking at. The real weakness, the relative weakness, I should say, is in large cap growth in particular, in America especially. When you look at the SMIDs, look at mid caps, small caps, micro caps, all putting in higher lows since June, right? June was the bottom. Things have progressed steadily since then. Traditionally, when markets are under pressure, stock market's about to crash, consumer staples are outperforming. In this market, consumer staples are underperforming. We don't want to compare staples to S&Ps because, you know, you got a ton of you know, growth, and, you know, if you really want to compare something to the overall market, right, and get a broader sense, I think industrials are the better way to do that, and look at consumer staples really breaking down. You've got Caterpillar making new all-time highs. Traditionally, that's not a characteristic of a bear market. You've got a very high correlation between Caterpillar, emerging markets, and base metals, here you're seeing EM making new 7th-month highs, copper making new 7th-month highs, along with Caterpillar continuing to do well. You know, a pond that I love to fish in is what we like to call the young aristocrats. You youngsters might not be familiar with Dividend Aristocrats, but some of you veterans out there are familiar with Dividend Aristocrats. These are companies that have raised their dividends every year for over 25 years straight. So just think about how great a company's doing if it has the ability to literally increase its dividend every year for 25 straight years. You know, think Coca-Cola, Johnson & Johnson, Proctor Gamble. I mean, you know the names. I don't have to tell you. But by the time it's done there for 25 years, you're probably not early in the cycle, right? So we create a list that we call the young aristocrats, the future aristocrats, or for you hip hop fans, the lil aristocrats. In this case, these are companies that have raised their dividends every year for between 5 and 9 consecutive years. So they've proven that they can do it for at least 5 years in a row, in some cases 7, 8, 9 years of dividend increases. So they're doing something right. But they're not to the point where they've done it for 25 straight years where you've missed the boat. So this is really a sweet spot that we like to live. Here you got a group of stocks that really stand out. Here's Landstar Systems, LSTR. You know, it's a transportation stock. Raised their dividends every year for 9 straight years. I think if we're above 160, I think you can own it. I think it really, really looks great. One thing that I want to talk about is precious metals. You know, gold has been making new all-time highs, price in every currency except the US dollar. Look at gold price in Canadian dollar, British pounds, Japanese yen, Aussie, euro, Kiwi, Chinese yuan, rand, Indian rupee. All these charts go from the lower left to the upper right. So I think it's only a matter of time before we see that in gold pricing United States dollars. You know, and I used to be a gold bug, you know, early in my career, right around the early 2000s, you know, 20 something years ago when I first came in the business. It was easy to be a gold bug. It was cool being a gold bug. We were making more money than anybody else, right? You had a bunch of people waiting for tech stocks to come back, right? They never did until like 14 years later. Sound familiar? People, you got all these investors that are just left holding the bag in these tech stocks that had no discipline or risk management process, and they're just waiting for tech to come back. You know, in my experience, they're probably going to be waiting for a long time. They're holding the bag for a reason. You know, those are the types of people that we want holding the bag. Let them keep holding it. You know, for those of us who you know, are disciplined and can move on and can adapt to market changes and new environments, you know, let those tech stocks go to zero. Who cares? It's not our problem, right? So it's very similar. You know, people are like, oh, I'm not going to buy gold. I'm going to wait for growth stocks to come back. All right, bro, keep waiting. You know, for me, you know, we're seeing a rotation into gold and silver. Look at gold and silver making new 6-month highs across the board. Look at this base in silver. You know, I think a retest of 50 could ultimately come. And if we retest 50 in silver, by the way, that's a double from here. You know, we could see silver at 80 or 100. Think about what these mining companies are doing in an environment like that. So I would encourage you to email me. We just dropped our precious metals report. You know, John can drop the link. Go ahead and email me and we'll provide that report for you where we really dive into precious metals. Because look at the, for you, you know, you youngsters might not be familiar with the Philadelphia Gold and Silver Index, but this thing is old school, broke out in November, and now we just got the GDX breaking out. This is the popular ETF. So you know how I know that gold miners are not in downtrends? Here are the 30 stocks in the Philadelphia Gold and Silver Index. And then across the board, we've got each of those relative to different moving averages. Their 5-day moving average, 10, 20, 50, 100, 150, 200, 250. So the further to the right you go, the longer the time horizon, the longer the trend. And what am I seeing here? A whole lot of green. So a lot of these names are above their moving averages. That means they're trending higher. They are not in downtrend. So I would highly encourage you to check out some of these precious metals and make sure to email me. Happy to send you guys the report. No problem at all. John, make sure to let everybody know. And I'll go ahead and send it out.
Will do, JC.
Yeah, for sure. Let's take a look at some energy. You know, you've had a monster decline in crude oil, 40-something% correction off the highs. I'm not one to trade crude oil futures because I like to sleep at night. If you trade crude oil futures, God bless you. Long against 76 makes sense to me, but bigger picture, for me, it's really the resiliency in energy stocks, despite the correction in crude oil. Very, very impressive. Here we're looking in blue at energy stocks on a relative basis in blue, and then in black, the correction in crude oil. So very, very impressive in my opinion. And what's even more impressive is really the oil and oil services. Look at Schlumberger breaking out above 52. I like this one long with a target, up near 77. But it's really the oil services in general look great. Oil services have been the worst of the oil and gas space for a long, long time. So the fact that they're the leaders now really stands out. And I think Schlumberger is a good example of that. Schlumberger is part of our Hall of Famers list. What we do is we take the biggest companies by market cap in the United States, and we sort by relative strength. So we're looking for the biggest, largest names in the United States, and Schlumberger is definitely near the top of that list. Another interesting dynamic that we're seeing is in broker dealers. Monster base. Here we're looking at broker dealers relative to the rest of the market. Major bearish to bullish reversal. Making new multi-year highs here, broker dealers on a relative basis. So you got a few names, Interactive Brokers building a nice base, looking to buy a breakout above 80 if we get there. Charles Schwab looking to buy a breakout above 80 if we get there. Look at Jefferies, long above 36. Look at CBOE. If we can start taking out 140, that will be a nice breakout. Donnelley Financial, DFIN, breaking out above 45. I like that long. So these are the types of names that we want to buy. We want to buy strength. Why are we going to wait for these crappy tech stocks to turn around? I think you're going to be waiting for a long time. We want to be in the stuff that's already working. Berkshire Hathaway, Uncle Warren wins again. These things are really working out well. Berkshire Hathaway, largest component of financials, really showing a ton of relative strength. The value investors, this is their time to shine. When interest rates are going higher, do growth stocks do well? No, growth stocks are the worst stocks in the planet when interest rates are going up. We know that. We have the data. So if anybody should be surprised that growth stocks are underperforming, either they haven't studied history or they're looking at their charts upside down. I don't know, but this is perfectly consistent with all historical norms where value stocks outperform industrials, financials, energy, materials. Those are the names that do well when interest rates are going up. And I don't know if you got the memo, but interest rates have been going up. So why on earth would anybody in their right mind think that growth stocks should be doing well? They should be doing terrible. And guess what? They have been. So again, perfectly normal. Now, this is probably the most important chart that I'm going to show you today. This is really the big one. You've got financials up top and home construction down below. And then back in 2007, you guys may have heard of it. There was something called the Great Financial Crisis. And here we're looking at the highs in the financials index right before the Great Financial Crisis. So, call me crazy, but this is one of the most important prices in the history of the stock market, the top in financials before the Great Financial Crisis. Just right, logically. So this was the highs in financials in 07. We got back up there in 18 and failed, got back up there pre-COVID and failed. Then we ultimately broke out after COVID. And then last summer, we successfully retested those levels, right? So as long as we are above those prior cycles highs, what's there not to like, right? In terms of financials. And if financials are going up, how bad do you think the market is? Same thing with home construction, right? Look at those former highs before the real estate bubble crash after 06, 07. We got back to those levels in 2018 and failed, got back to those levels pre-COVID and failed, ultimately broke out after COVID, and last summer successfully retested. So both financials and home construction, two very, very important stock market indexes, were able to hold above those prior cycles highs. I think that's constructive, pun intended, for both of these sectors, but also the overall market. And people are like, well, if tech stocks can't do well, the stock market can't do well. Tech stocks have to come back, JC. Well, au contraire, mon frere. Look at 03 to 07, where value stocks were outperforming those growth stocks the entire time. And guess what? We were in a raging bull market. Parties were frequent. Parties were great. I know. I was living in New York City, having a grand old time because it was in a bull market. And we weren't buying tech, and we weren't buying any of that stuff. We were buying energy and financials and industrials and materials and gold miners. Sound familiar? So here you see the Dow Jones Industrial Average really, really outperforming the NASDAQ. Here is the NASDAQ is making new lows relative to the Dow. It looks exactly like the growth value index. Why? Because the NASDAQ is just a ton of growth stocks, and the Dow Jones Industrial Average is much more well-rounded, only 16% technology versus the NASDAQ's like half tech. And that half tech doesn't even include Google or Tesla or Amazon or Facebook. Those are like in other discretionary and communication sectors. So if you include all of those, basically 100% growth, 100% tech. And the Dow is just not that at all, much more diversified, which is why you're seeing that tremendous outperformance. Before we start taking any questions, I wanted to bring up one more thing, which I found very interesting, is that both, we talk about financials and home builders above the prior cycle's peak, which is very constructive for both of those sectors and the overall market. We're seeing the same thing in Bitcoin and Ethereum as we speak. As a matter of fact, let me, I can bring up the chart quick. We can actually do this live. Let's see how good I am. Let's see. Because I really want to show you, because it's a really nice chart. Boom. So here's Bitcoin. Bring this up right now. So here we're looking at Bitcoin. You see those prior cycles highs, right? You see that, guys? This is the prior cycles highs in Bitcoin, and that found support. And I want to show you the same thing in Ethereum. We're seeing the exact same thing that we saw in home construction and financials. We're seeing that in Ethereum and Bitcoin, right? You're seeing that former peak in late 2017 turning into support. In Bitcoin, that peak in late 2017, early 2018, turning into support. And then for you Dow theory enthusiasts, who are watching the Dow Jones Industrial Average and Dow Transports confirming or diverging from one another, we can apply those same principles to Bitcoin and Ethereum. And with the lower lows in Bitcoin in the fourth quarter of last year, Ethereum was already putting in higher lows. So Dow Theory 101 suggesting that something is changing. And when you look at the sentiment around there, people are, crypto's a scam, blah, blah, blah. People are obviously very, very confused. I'm looking at very constructive behavior. If Bitcoin and Ethereum are above those prior cycles highs, I think that you need to be long both Bitcoin and Ethereum. And when you look at countries around the world with a less egregious exposure to growth stocks, you're going to see a lot more strength. Things like UK is 0.0% tech, Mr. Blutarski. And sure enough, we went out last week at new all-time highs. You know what you don't see in downtrends, folks? You don't see many all-time highs in downtrends, right? That's just math. Look at the Netherlands, looks great. Look at Denmark, going from the lower left to the upper right. Look at France, right? Holding above those prior cycles highs. Look at Germany. These don't look like downtrends to me. Look at the Euro STOXX 50 making new 10-month highs. Look at Europe. This is equivalent to the S&P 1500. This is the Euro STOXX 600. Went nowhere for 20 years and now looking to break out of a historic base. So, like I said, I'm not really seeing, the bear market that people are calling for. Quite the opposite. We're seeing a lot of strength. We're seeing positive rotation. We're seeing momentum picking up. We're seeing expansion in participation and washout levels of sentiment. It's a nice combination to be long, particularly in a year that historically should do very, very well for equity investors. So that's how I see it, John. What do you think?
No, the charts don't lie. That's one of the issues that you and I have talked about. The charts are there for a reason, and people follow them and watch them. I have a question for you already in the queue. And this person asks, many experts have said the market requires a VIX move into the 30 to 50 range before the market, as measured by S&P, bottoms. What say you?
Yeah, whoever says that clearly has, is bad at math, right? No, that's not the case at all. The VIX, understand what the VIX is. We don't need to overthink the VIX. The VIX is a measure of premium, at the money premium, essentially, for the S&P 500, right? Which is one index in one country, which is a large cap index with an egregious amount of growth exposure, right? That is not the stock market. It is one index in one country with a ton of growth. And that's all it is. And the VIX is a derivative of that. that just identifies the how expensive those premiums are for the S&P 500. That's all it is. So we don't have to overthink things in terms of bull and bear markets with something like the volatility index. Listen, one way to make sure you're going to drive yourself crazy, like a surefire way of driving yourself crazy, is to overthink the VIX.
All right. As we're waiting for any other questions, I have a question actually, JC. As I was following your Twitter feed, you had noted that you were seeing some unusual options activity going on out there. For my clients and prospects here that do and get involved in options, what are you seeing and what do you think?
Yeah, I mean, listen, you know, anybody can come up with like an unusual options activity scan. We like to we put in very stringent parameters in order to identify very unusual activity, very aggressive directional bets by institutional players. You can see our latest update here on some of the stuff that we've seen more recently. Things like rocket companies and Lyft. Just a ton of different activity. Boston Scientific. One name, Pinterest, that stands out where we've seen some unusual activity for sure. PINS, some out of the money calls going out a month out. If we're above 27, I like this trade long for 10 points to the upside. Could get 30% of upside. But now, just because there's unusual options activity, just because there's very aggressive positioning, doesn't mean we're just going to blindly buy things. We want to trade based on our own parameters, not somebody else's. So for me, you know, if we're below 27, they could buy as much as they want. They're going to do so without me. For me, Pinterest only above 27 with a target up near 37. So nice question. Also, ARK, big activity on the ARK, you know, which is a name that's gotten crushed. You know, I don't necessarily know that we're in the beginning of a new bull market in ARK and growth and Kathy Wood and the whole thing. I don't know about all that. But for a trade, if ARK's above 35 with a target up near 50, I like that. But that's really about it.
Okay, I got another one for you, JC, and this one's about gold. Do you think that gold will show upside if the US dollar remains neutral or gains strength?
Well, remember, the dollar has been very strong over the last couple of years, and gold priced in dollars has just kind of been flat for the most part, but price in all the other currencies, gold is doing very well. So yes, if the dollar remains elevated, I mean, the dollar just got smoked. But if the dollar can catch a bid and keep going, I think gold price in dollars remains under pressure, but in some of these other currencies, you know, continues to go up. So I think it really just depends on what you're denominating gold in. You know, people think gold is a commodity. Doesn't act like a commodity. It doesn't behave like one. So we don't treat it like one. You know, it behaves like a currency. So we treat it like a currency, right?
All right. We're pushing up against our 40 minutes. We have no more questions. So I'll start reading the outro and just see if anything comes in at the last minute. Sure. You know, thank you so much to everyone. We're about to conclude our monthly January CAPIS research briefing. We'd like to thank JC and AllStarCharts, and all the data that they put up on our screens. Tomorrow on our website will be the recap blog. I'll be sure to include a link to JC and AllStarCharts so you can contact him tomorrow, or if you're an attendee today, reach out to me at jdantona@capis.com, and I'll be sure to relay anything to JC and get you his information as well. Our next briefing will be held on February 16th, where we will turn to fundamental analysis, bringing back Nicholas Colas and Jessica Rabe of DataTrek. So be sure to stay tuned for that. It'll be a good production. And on behalf of CAPIS and, of course, AllStarCharts and JC here, thank you so much for watching. Have yourselves a great trading day. Thank you.
Adios.
Take care, JC.
See ya.